how much can the arrest of a sitting head of state actually shake global markets? At first glance, the images tell a dramatic story: Venezuela on the map, gold jumping sharply, oil prices barely moving. But experienced investors don't stop at price spikes or breaking headlines. They look for signals. Because the real question isn't whether prices move today, it's whether the market is starting to price in systemic risk. And right now, there are 5 signals professionals are watching closely to distinguish a temporary geopolitical shock from something that could ripple through the global financial system. Over the weekend, political tensions around Venezuela escalated sharply after U.S. authorities detained Nicolás Maduro, bringing long-running legal and diplomatic frictions back into the global spotlight. Events like this tend to generate intense headlines and emotional reactions. In the short term, they often create noise rather than clarity. Markets react first, but not always accurately. That's why professional investors treat breaking geopolitical news with caution. The initial price moves matter less than what happens next. Data, not headlines, ultimately reveals whether risk is being repriced in a meaningful way. The goal here isn't to speculate on political outcomes. It's to observe how markets process uncertainty. In this video, I'll break down 5 specific signals investors are watching closely to understand whether this event represents a contained shock, or the early stages of broader systemic risk. The first signal investors are watching isn't the oil price itself, it's the structure of the oil market. Venezuela matters because it produces oil. Roughly 1 million barrels per day, about 1% of global supply, comes from Venezuela. So the natural question is whether this event creates a supply shock. To answer that, professionals look at the futures curve. When the market is in contango, futures prices are higher than spot prices. That usually signals ample supply and little urgency to secure oil right now. Storage is available, logistics are functioning, and the system isn't under stress. Backwardation is the opposite. Spot prices trade above futures, indicating tight near-term supply and a willingness to pay up for immediate delivery. That's when markets are signaling real concern. So far, the oil curve remains in contango. That tells us something important: despite the political shock, traders do not see an imminent disruption to physical supply. Venezuelan infrastructure is still operating, exports are still flowing, and alternative supply sources are available. If oil markets were genuinely worried, you wouldn't just see higher prices, you would see the curve flip into backwardation. Until that happens, the message from the oil market is cautious, not alarmist. The second signal is how much fear is actually being priced into U.S. equities, and the cleanest proxy for that is the VIX. The VIX reflects the market's expectation of stock market volatility over the next 30 days. In simple terms, it's a real-time gauge of how anxious investors are. Right now, the VIX is hovering around 14.5. That's a low level by historical standards. It suggests investors are not rushing to buy downside protection, and they are not positioning for large, disorderly moves in equities. For context, during periods of genuine market stress, the VIX behaves very differently. Last year, during tariff-related shocks, it briefly surged above 50, a level associated with forced deleveraging and widespread risk aversion. The contrast matters. When geopolitical events threaten to spill over into the broader financial system, fear shows up quickly in volatility markets. When the VIX stays muted, it's a sign that equity investors still view the shock as contained rather than systemic. The third signal sits beneath the surface, in rates and credit markets, the parts of the system that tend to detect stress before equities do. If investors were starting to reprice global risk in a serious way, you would expect a familiar pattern. Money would flow into safe assets, pushing U.S. Treasury yields sharply lower. Inflation expectations could rise if markets feared an energy shock. And credit spreads would widen as investors demanded more compensation for default risk. So far, that combination hasn't materialized. The 10-year yield is holding around 4.19%, while the 2-year sits near 4.48%. Movements have been modest, not the kind associated with a sudden flight to safety. Inflation break-evens remain stable, suggesting markets are not pricing in a sustained supply-driven inflation shock. Credit markets tell a similar story. Investment grade and high yield spreads have not meaningfully widened. That matters, because credit often reacts before equities when stress is becoming systemic. Venezuela's own bonds, already deeply distressed, offer little new information. The signal investors care about is whether stress migrates into broader global credit. At this stage, rates and credit are signaling stability. Not complacency, but a judgment that the shock has not yet crossed into system-wide repricing. The fourth signal is gold, and here the message is more nuanced. Gold has clearly benefited from the geopolitical shock. During the January 5 session, prices briefly jumped by nearly $100 per ounce, with silver rising more than 4% at the same time. That kind of move reflects a sudden increase in demand for protection rather than a reassessment of growth fundamentals. Gold tends to perform best when investors are hedging against uncertainty they can't easily model. It's not just about inflation or interest rates. It's about confidence in how the global system functions under stress. Some forecasts reinforce that narrative. Standard Chartered has projected gold prices as high as $4,800 per ounce this year, reflecting expectations of persistent geopolitical risk and sustained demand for safe assets. But context matters. Gold is rising sharply while equities remain relatively calm and credit markets are stable. That combination suggests investors are buying insurance, not liquidating risk wholesale. When gold surges alongside collapsing equities and widening credit spreads, that's panic. When gold rises on its own, it's caution. Right now, the signal from gold is defensive positioning, not systemic flight. The fifth signal is the hardest to quantify, but often the most important: whether this event increases the risk of spillover into other geopolitical flashpoints. Markets are less concerned with Venezuela in isolation than with precedent and escalation. The key question is whether this action is perceived as a contained, tactical move, or the beginning of a broader shift in how major powers confront adversaries. If investors believe this event materially raised the probability of escalation elsewhere, in the Middle East, Ukraine, or around Taiwan, you would expect to see a sustained rise in geopolitical risk premiums across assets. That would show up as persistent pressure on equities, tighter financial conditions, and a more durable bid for safe havens. So far, markets appear to be treating this as a localized shock rather than a catalyst for global contagion. Risk premiums linked to geopolitics look temporary, not structural. That doesn't mean the risk is zero, it means investors are waiting to see whether this event changes behavior elsewhere. In other words, the market isn't asking whether Venezuela matters. It's asking whether the rules of engagement are changing globally. So what should investors actually watch over the next 1 to 2 weeks? In oil, the key isn't whether prices tick higher or lower, but whether the futures curve flips into backwardation. That would be the first clear signal that supply stress is becoming real rather than theoretical. In equities, watch volatility. If the VIX remains subdued, markets are still treating this as a contained shock. A sharp, sustained move higher would suggest risk is being repriced more broadly. In rates and credit, focus on direction and speed. A rapid drop in Treasury yields combined with widening credit spreads would indicate a shift toward genuine risk-off behavior. In gold, the question is intent. Is the rally driven by hedging and diversification, or does it start to coincide with stress across equities and credit? The former is caution. The latter is panic. And finally, in geopolitics, watch for escalation or contagion. The market's base case still assumes this event does not materially change the global balance of risk. That assumption can change quickly if tensions spread. The takeaway is simple: don't trade the headline. Watch the indicators. They tell you how the market is actually pricing risk. Do you see this as a short-lived geopolitical shock, or the early stage of something that could ripple more broadly across markets? That distinction matters, because markets don't move on drama, they move on whether risk becomes persistent and systemic. If you found this framework useful, share your perspective in the comments.